I first want to start out by welcoming all our new subscribers this week. I've heard from a lot of you. I've gotten emails and great feedback. If you haven't written in yet or you have any questions about the service, please reach out to us, automaticfortunes@banyanhill.com. I want to talk about a few things today, but first I'd like to just give a general overview of the market, what's been happening lately. Maybe you've seen the headlines. The market suffered its worst decline last week of about 3%, and there was concerns about what's happening with China and the US and the trade war or trade tiff or whatever you want to call it. And I had written about last summer and actually went on Fox Business News to talk about this, the idea that the US and China are in stronger positions right now than they ever have been before, which means that this trade war or skirmish could last longer than most people anticipate. And the number one reason for this is that on the Chinese side, they're not as reliant as exports as they were a decade ago. So China used to be a much larger exporter before the financial crisis. Exports as a percent of GDP were about 18%. Now they're down to about 10%. So exports in the Chinese economy has declined significantly. The Chinese government is also trying to create more of a domestic economy. And the shift to consumerism means that they don't rely on exports as much as they did. On our side of the pond, the United States is dealing with a very strong economy with obviously a very stubborn or blunt president who is willing to take this to as far as it can go to get a better deal. So that's why I think we haven't really reached an agreement yet on the trade impasse, but I think that something will happen in the future. Just because there were some steps taken this week I'll get to in a moment. But the reality is the trade with China is a lot less of a factor on the market than the Fed. And there was a big sell-off last year, late last year. The markets were down about 20%. And I was writing about the time that the Fed had shifted its stance. They were hawkish. The Fed was really ready to raise rates at the end of last year. And suddenly when they saw the weakness and they saw things happening overseas, they shifted their posture to become what's known as more dovish, which means they don't anticipate any rate hikes in 2019. And as soon as that happened, the markets bottomed and started rallying. And now we're back up to where we were about last October. So we've gone through this pretty big roller coaster where the market sold off from October to December, and then they've rallied. I think because the Fed is going to remain on hold for the rest of the year, that actually indicates something very positive for us and for the market. Because as long as investors don't anticipate the Fed to increase rates too quickly, it means the economy continue growing at this 2 to 3% pace, what we're at right now, and the market should be fine. Valuations are pretty much in line where they've always been. So that's my outlook on the market. And I think like any of these trade tips or whatever, when the market freaks out, there are buying opportunities, because I do see that this bull market, which has gone on now since 2009, won't end until we have a little bit of a euphoria or mania towards the end. And I think that is not what we're looking at right now. So I do see upside ahead. So I want to thank everyone for tuning in this week. If you have any questions, please reach out to us, automaticfortunes@banyanhill.com. Have a great week, everyone, and I'll see you soon. Thank you.